Hello there, in today's video I'm going to demonstrate the power of compounding and how you can use it to increase your wealth with a one-time investment. So we'll take that investment and we'll see what would happen if you put it in a savings account and reinvested the interest over a 20-year period, and we'll compare that to what would happen if you put it in a dividend growth investment stock, and we'll look at different scenarios for that dividend growth investment stock. 3 scenarios. The first one where the stock price stays the same, the second one will be where the stock price, the share price, is decreasing, and the third scenario will be where the price is increasing for the duration of the period, all whilst the dividends are being reinvested. And we'll take a look at what would happen with your capital and how much you would make in each of those scenarios, which one would give you the biggest return on investment, biggest dividend yield at the end, and which one would give you the biggest capital growth, so you can see the outcome of those investments and which would be the best, and you may be surprised by the outcome. If you're new to this channel, welcome. My name's Andy, and on this channel I like to talk about money and success. If you're interested in making, saving, or investing money, please be sure to hit that subscribe button down below, hit the notification bell, and then you get notified every time I release a new video. And if you find this useful, please remember to give it a thumbs up, because that helps the YouTube algorithm, which in turn helps me, and of course I do appreciate it. With that said, let's dive in. The power of compounding. Fixed interest savings account versus dividend growth investing. As Albert Einstein said, compound interest is the 8th wonder of the world. He who understands it earns it. He who doesn't pays it. Now that's profound. Let that sink in for a moment. He who understands it earns it. He who doesn't pays it. And that's why it's so important that you learn about compound interest and the power of this, which I'm going to demonstrate in this video. What we'll cover in this video: the value over 20 years of a savings account with interest being reinvested, the value over 20 years of a stock with dividends being reinvested, and we'll look at that in 3 different scenarios. Firstly, with no growth in the share price, secondly with growth in the share price, and thirdly with a declining share price. We'll also look at how the yield on your initial capital increases over time. For the savings account, the example I'm going to use is from UBL. It's a personal notice account whereby you can start with as little as £1 all the way up to £1 million. As you can see on the screen now, 35 to 90 days notice is required depending on which one of the 2 accounts you go for. So presumably you'd go for the 35-day notice account. Interest rate is 1%. That's a fixed 1% interest rate, and that's calculated twice per year. So those are the assumptions that I'm using for the savings account in this example. So the stock we're going to use for this example is AT&T. The assumptions are going to be that the buy price is $27.50. The starting dividend yield is 7.71%. Now, the reason I've used those is that's exactly what they were when I created a previous video about AT&T, which I'll put a link to up the top there and in the description down below. So if you are interested more in AT&T, feel free to check that out. It's one of those stocks that people love and other people hate. So it really is, I suppose, as dividend stocks go, quite controversial dividend stock, but it is a dividend stock that has had an increase in dividend for 36 consecutive years. So I think it's fair that I use this as an example for forecasting forward. As I said, if you're interested in more information about AT&T, I'll put a link in that description down below. Check that previous video out and you'll be able to learn more about it. And obviously if you do choose to invest in it, do your own research first. How's that? Dividends are increased at the same historic rate of 1 cent per quarter each year, as I'll show you in a moment. For the examples, we will assume the same amount in both the savings account and in the shares account at the start of $2,750. That allows us to simply start off with 100 shares. All dividends will be reinvested, and obviously, as I said earlier, with the savings account, all of the interest from the savings account will also be reinvested. This graph here shows a historic dividend from AT&T, which is, as I said, is the stock we're using for this example. What I want you to look at is the dividend increases from 2008. You can see it was 40 cents every quarter in 2008. It then went up by a penny to be 41 cents in every quarter of the following year, 2009. It went up by another penny to be 42 cents in every quarter of 2010, and so on. That exact same trend you can see there has continued. It's basically gone up 1 penny per year for the quarter, basically, and you can see that quite clearly on this chart, and I'm assuming that that exact same trend will continue. In the past, you can see it had actually gone up higher. You'll see there it went up higher, there it's gone up higher, but just for the base of this example, to keep things simple, I'm just assuming that 1 penny increase per quarter, so 4 pennies per year. So this chart here shows example 1, the red line being the share pot, and you can see there that the share pot has grown quite dramatically, starting out at the $2,750 and increasing up to over $16,000 by year 20, versus the savings pot, which has had the 1% interest reinvested. You can see it has grown slightly, but nowhere near as much as the shares pot. Now, I do want to quickly interject here. I don't think everybody should just rush out and just put all of their money into stocks and shares. That's not what I'm trying to say with this video. It's very important that you have a money management system in place. If you don't already, check out my previous video, how to manage and budget money, and I'll put the link in the description down below for that as well. And check that out because it's super important that you've got your pots set up. Once you've got your pots set up, then you should be investing some money, and this video really demonstrates just why and how it can make you wealthy over time when reinvested. Let's carry on with the slides. So here's example one in a table form for you. So you can see in the orange here on the left hand side, we started with initial investment of 100 shares at $27.50 per share. The share pot started off at $2,750. As you can see on the right hand side in the green table, the savings account also started off with $2,750. Now then, back to the orange table, you can see that the balance after 20 years was $16,115, which is comprised of 586 shares at $27.50 per share, because this is the example where the share price has stayed the same. So the share price hasn't changed. Your dividends that have come in have been used to buy more shares, and as you can see here, those shares have actually equaled an extra 486 shares, which means you've now got 586 shares, which is how come you've got such a bigger pot than you had before. Whereas in the savings account, you can see that your balance, whilst it has still grown, it hasn't grown as much, but your interest has been reinvested in your savings account, and that's how you've arrived at that figure. So example two. So in this example, the share price was increasing by 4% per year, and you can see again the red line shows you how the shares have done. So your share pot has grown, and in this instance it's now grown to over $20,000, whilst the blue line still signifies the savings account, which has been growing at 1%, and obviously that's the same amount as it was before, as you can see in this table here. So you can see now the savings account has still grown to the exact same figure of $3,373.97, whilst the share pot has now grown to $20,160.24. But look at the interesting thing here. You've got a total of 334 shares, but now look at the value of those shares. Each share is now worth $60.36. So that's what the value of the shares would be if every year the share price increased by 4%. Notice you've got less shares, but they're worth more per share. And it's that combination that has created the bigger share pot and that $20,000 figure that you see there. So let's now take a look at what will happen if this share price decreases. So this graph here shows what happens when the share price is decreasing. The red line shows the share pot growing, and as you can see, it's made it to over $18,000 there. You can see what the savings rate has done, which is exactly the same as before, and that's the blue line there, and that is with the share price decreasing 4% per year for the entire duration of the 4 years. One thing I want you to notice here is how it's actually climbing faster nearer the end of the graph. In the later years, it's almost going parabolic there. That's because the dividend is increasing whilst the share price is decreasing, which means you're actually buying many more shares each time you buy more shares each year, which is in turn growing the value of the pot. Let me show you on the table. So here we see on the table here, again, you started with 100 shares, but if you look down there to the balance after 20 years, you've actually got 1,527 shares. Even despite the fact the shares are worth much less now because they've been decreasing by 4% per year, so they're only worth $12.43 per share. That $12.43 per share times by the number of shares you've got, 1,527 shares, still gives you a really good sized pot of $18,980.61. And obviously the savings account on the right hand side there has remained the same. So now let's compare how the three examples did against each other. So this graph shows you the comparison of the investment. So this is your total share pot. So the red line signifies the value of the share pot where the share price was staying the same. So the share price started at $27.50 and ended at $27.50. That's the red line. The blue line is our state savings account, which obviously started at $2,750 and ended at just over $3,000, as you can see there. The green line is the line that signifies the share pot where the share price was increasing by 4% per year. And the yellow line is a very interesting line because this is the one where the share price was declining by 4% per year. But look how it is catching up the green line. And I can tell you, if I'd have forecast this forward, it would have only taken another 2 years and it would have actually overtaken the green line. Now, the reason I didn't is I didn't want to give you an unrealistic view of the world, because by that point, the dividend yield on the actual share price at that point in time would have got so high that it would have been unrealistic. And the reality is the share price, providing that dividend was being paid and increased like that, would have never have dropped that low. Because if it had of, think about it, it would be a license to print money. The minute you could, if I said to you, give me $1 and I'll give you $2, you would give me that dollar. And if I said to you, give me $1 and I'll give you $1 every year for the rest of your life, you'd be like, how many dollars can I give you? It's as simple as that. So quite simply, the yield can never get too high, because if it gets too high, the share price will automatically be pushed up because investors will pile in and see it as a good value stock to buy. So providing it keeps increasing its share price, and that was the reason I didn't want to really extend this any further, because I didn't want to give you a false sense of the world that actually if you've got a share price that's falling, there's usually a reason for the share price falling. The share price is falling and the dividend yield is going up over a 20-year span. The truth is something's gone wrong in the world. I would be surprised. I've never seen that happen. If anybody knows of an instance where that's happened, let me know in the description down below. Let me know what stock it's happened on, because I need to be buying me some of that, because clearly the dividend yield would be insane. But yeah, that's the situation on that one, and I hope that makes sense. Let's look at the table there. So the table lays it out for you quite simply. So you can see the savings account on the left-hand side there started with initial investment of $2,750, added all three of our share examples. The balance on the savings account after 20 years was $3,373.97, which made a total gain of $623.97. So over the entire 20 years, that's how much money you made on that option. Now, had you gone for the share pot that just says share pot, that's the one where the share price stayed the same. So assume the share price does not go up and the share price does not go down. But remember, those dividends have been increased year on year. Your balance after 20 years would be $16,115. Your shares held after that period of time would still be 586. So you would have grown from 100 shares at the beginning to 586. The share price at year 20, as stated, would be $27.50, which would give you a total gain over the 20 years of $13,365. Now, if we move on to the next column, you can see there what would happen if the share price was to decline every year by 4% per year. That share pot again starts again with $2,750. Your balance after 20 years is $18,980. You've got a whopping 1,527 shares held after 20 years, and the reason you've got that many shares held after 20 years is because your reinvestments are buying the shares at cheaper and cheaper prices, because the price of the shares has been falling every year, so that by year 20 the price of those shares per share is only $12.43. Still, even after that massive share price decline, you've still done better than if the share price had stayed the same, and you now have a total gain over 20 years of $16,230.61. Now, had the share price increased by the same amount each year instead of decreasing, you can see what would happen there in that final right hand column. So again, you start off with $2,750, but your balance after 20 years now is larger at $20,160.24. But you earn far fewer shares. If you look there, you only earn 334 shares, but you don't need as many shares to have a larger total gain, because 334 times by the share price in year 20, which would at that inflation rate would be $60.36 per share, would give you a total gain over 20 years of $17,410.24. But that's not the entire end of the story. What I want you to look at next is the return on your initial investment. So this slide here shows you your annual return on initial investment in percentage terms. So you see on the left hand side it starts at 0% and it goes all the way up to 180% on the left hand side there. So you'll see how that grows over time. So in year 1, we've got time along the bottom going from year 1 all the way to year 20, and you can see that the annual yield, that's a dividend yield on the initial investment for the stock portfolio pot, which is the red line where there was no growth in the share price, you can see how that increased from just over 7% per year to just over 60% per year by the end of year 20. Whereas the savings account, which is signified by the blue line, went from 1% to just slightly over 1%. The green line, which is the line that signifies the yield for the share pot, where the share price was growing by 4% per annum, has increased as well, and you can see there it's made it well over 30%, but not as high as the yield, the dividend yield on initial investment. This is, bear in mind, for the pot that had no share growth. And the reason for that is because there's less shares in that pot, which you'll see in a moment when we look at the table. The yellow line signifies the return on initial investment per annum for the share pot where the share price was decreasing, and as you can see there at the end, that goes pretty much parabolic, and that is the very reason why that is the portfolio that would have overtaken even the green portfolio, the one where the share price was increasing, given a little bit more time, because its return on investment was just simply phenomenal. So onto the table. The green table, as always, is for the savings. So you can see we had an initial investment of $2,750. The balance after 20 years was $3,373.97, which would give an annual interest on your initial investment in year 21 of 1.21%. And that's because your annual interest in year 21 would be $33.74, and that is 1.21% of the $2,750. Now your average return over the period, over that 20-year period, was 1.1%. That's what it averages out at. Over to the orange table now. Let's look how 3 different share pots would have performed. So the share pot we'll start with first, the one that's just called share pot. That's the one where the share price stayed the same. So it started with a share price of $27.50 and ended with a share price of $27.50. You'll see there the balance after 20 years was $16,115, and the annual dividend yield on the initial investment is 66.62% per annum in year 21. And presuming you didn't invest anymore, that's what it would stay at, because you'd have the same number of dividends. Because your dividends are calculated, if you look in the next row, it shows you there 586 shares times by the annual dividend of $2.92. That will give an annual dividend of $1,711.12, and that number is 66.62% of the initial investment, which is a $2,750. Now, if you're interested to know what your annual average return was, both dividends and capital over the period, it was 24.3% in a pot where the share price was remaining the same. So let's now have a look what happened in the pot where the share price was declining by 4% per annum. The annual dividend yield on your initial investment is a massive 162.14%. Now, the reason for that, if you look in the cell below it, you can see, is because you now have 1,527 shares. And when you multiply that by the annual dividend per share of $2.92, which is what it would be after that growth, we would get a dividend of $4,458.84 per year, which is obviously 162.14% of your initial investment of $2,750. Now, if you're interested to know what your return average was, both dividends and capital, over the 20-year period, it was 29.5% per year. Now let's compare that now to the pot whereby the share price was increasing every year, 4% per year. With that pot, your annual dividend yield on initial investment in year 21 would be 35.46%. And the reason for that is because you have far fewer shares. If you look, you have 334 shares, still paying the same dividend per share of $2.92, which gives a total annual dividend of $975.28, which is 35.46% of your initial investment of $2,750. But because the share price was going up over that period of 20 years, that one actually performed slightly better than the one with the declining share price, and it gave you a return of 31.7% on average per year, because the share price was going up instead of down. As I said earlier, if that had have been continued, the one with the declining pot would have actually won. And if you stopped investing at that point, the one with the declining pot would still be doing very well because it would have that bigger income. If you were having to live off the dividends, it's giving you a bigger income to live off simply due to the fact that you own more shares. Now, the key takeaways here are, provided that dividends continue to be paid over the long run, the value of an investment with returns being reinvested in a dividend paying stock will beat money left in a high interest savings account regardless of if the stock price goes up or down. Your return on initial investment grows over time, and remember, at the start the dividend yield was 7.71%, but after 20 years with dividends being reinvested and no change in share price, the yield on your initial investment would be 62.22%. So hopefully this gives you an insight as to why dividend investors, particularly dividend growth investors, really don't mind too much if shares go up or down. What they're concerned about is, are the dividends increasing? And as long as the dividends is increasing, they're still buying. Because as you saw in this example, if the share price is going down, in the long run, certainly after 22 years, say 30 years for sure, you'd actually be better off, providing, of course, the dividend keeps being paid and keeps increasing. Of course, that's not a realistic scenario. The fact is that if the share price was dropping so low and the dividends were getting higher and higher, there'd come a point whereby people would pile in and buy it, which would prevent the share price from falling so low in the first place, because a share with good cash flow would have an intrinsic value, so investors would be investing in it, which would prevent the share price from falling to a ridiculously low level. So the parabolic curve in real life would never actually happen. But it gives you a good example as to why you want to be buying low and selling high, or ideally not selling at all if you're a dividend growth investor, because your objective wants to be to acquire as many shares as possible so that you get as much in dividend income as possible, specifically shares with dividends that increase over time, because as you can see, your return on your initial investment increases over time as it compounds over time. And that was the point of this video, was to illustrate that. If you're interested in learning more about dividend stocks, please do consider subscribing to the channel. There's a link down below so that you can see the videos that I produce. My videos, I have produced a number already reviewing dividend stocks, and I give you my take and my feedback and a little bit of analysis on them in those videos. I hope you've enjoyed this video. Thanks for watching, and bye bye.